Happening right now, the president getting set to head to Brussels for a trip to Europe from New York City this morning. Good morning, good morning. Futures down 0.6%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Ferro.
Live from New York City, we begin with the big issue. President Biden gearing up for a big week in Europe, set to take off from Joint Base Andrews any moment now, heading to Brussels. Team coverage starts right now with Bloomberg's Maria Tadeo in Brussels. And Marie, down in Europe as well. Let's start with you, Maria. The line from the President of the United States on his way out from the White House sees a real threat of Putin using chemical weapons.
Yeah, that really reflects what is the real concern now is where do you go on a war where it's day 26, you've completely stalled your operation on the ground. And at this point, it's very clear that Ukraine is not going to surrender any of its major cities or territorial integrity. The concern is now, of course, that Vladimir Putin is going to have to escalate first to bring on the pressure to the Ukrainian government and then two, to terrorize the population so they stop putting up a fight. And this is a reality, Jonathan. We're now on day 27. This is a war that is much longer than Vladimir Putin had originally planned. And then, of course, the longer it goes on, the more brutal it gets, but also the most expensive or the more expensive it gets for the Russians. And this is really the dilemma that's facing now Vladimir Putin. There's a real concern here from NATO, from the European Union, but also the United States. This could really escalate things further. And then at that point, the question is, what is the international community going to do? How do you respond to the use of weapons that could really endanger the life of people in a way that is very, very hard to imagine from our side of the world?
Anne-Marie, following the pictures of the president about to board Air Force One on his way to Brussels from Joint Base Andrews, we've been talking about deliverables throughout the whole of today. Typically, an event like this one is highly orchestrated. You already know the outcome before the president even gets there. This is different. That's something that BTIG told us earlier this morning. How different is this moment?
It's incredibly different, Jonathan, because the stakes are so high, and the president now just leaving the White House telling reporters that there is a chance that the Kremlin could resort and President Putin could resort to using chemical weapons. That is a threat that is incredibly high for this president to step up to try to address alongside his allies. And just yesterday, Jonathan, we heard from Biden's national security advisor, who will be joining him on Air Force One, Jake Sullivan. He said that the president and his allies will impose further sanctions on Russia and tightening the existing sanctions to crack down on evasion and to ensure robust enforcement. But since the very beginning, as the United States has tried to, and they've succeeded in terms of this strategy of working in lockstep with the European partners, when it gets down to the really difficult issues like energy, there are going to be cracks in the fault lines.
There's a broader relationship at play here with NATO. That will take place on Thursday. On Friday, there's a more unique relationship between Poland and Russia we need to think about more so, Maria, and the president's role in that. What does the Friday meeting look like after Thursday's efforts?
Well, this is a bilateral meeting that will be incredibly important between the United States and Poland, and it is incredibly important for the Polish government because the pressure is on when it comes to Russia. Today, we see that the Polish are going to expel from their country 45 Russian diplomats, and the Russians have already responded. This is not going to go unanswered. These are two countries that have a very complicated historical relationship going back, you could argue, to the Second World War, that have a very complicated relationship at this point. But also, when you look at the European countries, it really is Poland that sticks out. They are the ones that continue to say we have to be much more forceful on the Russians. We should not be afraid of Vladimir Putin. The fact that we're fearful, that plays into his hands. And then, of course, they're stuck with a weapons delivery that could target or make the country a target to Russian hits. And then, of course, you have the refugee crisis that's also playing into this country that's already accepted 2 million people in the space of 4 weeks. And Jonathan, the impression is that this war is not going to end from one day to another. So, in fact, the displacements could continue for way longer.
MH, you would have been following the news that we had out of Interfax earlier this morning, citing the president of Russia, Vladimir Putin, saying the following: he will demand the countries it has labelled unfriendly, you know those countries well, the United States, the United Kingdom, the countries that make up the European Union, he'll demand those countries must pay in rubles for Russian gas. He's ordered the central bank, the government, in a week's time to determine the scheme of ruble payments for Russian gas. Russia will continue supplying contracted volumes, will only change the payment currency. What can this president do, AMH, when he lands in Brussels to help his European allies cut back on their dependency of Russian energy?
Jonathan, they have been doing it all along. They've been doing it for months ahead of the invasion, going around talking to producers like Qatar. And what did we see over the weekend? German economy minister in Doha inking an LNG deal. The issue is this is not an infrastructure or a change of how they get their natural gas that could be turned on a dial overnight. This takes time. You need LNG terminals. Germany does not have them. It's going to take at least likely a year. Then on top of that, potentially they can use some of these offshore floating terminals. But the issue is this cannot be done overnight, which is always going to be the struggle with trying to decouple Europe from the fossil fuel industry in Russia. But, Jonathan, quickly, on Putin's memo there is citing of this demand about natural gas shipments in rubles. I would be interested to know what would happen if they don't. Because right now, this is one sector of that economy that Putin still is able to has access to and to get some capital from.
The President just stepping on board to Air Force One. The door will shut very shortly. From here, from Joint Base Andrews to Brussels, about a 8-hour flight time into Brussels. They'll land later on this evening. Maria, I want to come to you on the same story. When the President gets to Brussels, this effort on gas, they might not be able to pull back on gas anytime soon. Can they do something on oil?
Well, if you ask me at this point, and again, it refers back to the conversations that I've had for the past 48 hours in Brussels, I've pretty much asked 6 different officials, are we going to see anything that looks like a ban on oil, gas coming from Russia? And the answer is we have to get real. It's very difficult to unplug our economies by Friday and decide we can do the same as the United States has done to that extent. It would send our economies into a recession. That's very clear. But even if they accept the economic price and the economic tag that will come with this, believing that it is worth helping Ukraine to a level that we haven't seen until now, nonetheless, how do you switch over from one day to another? You know, the question the Europeans will ask is, where do we get this oil? Where do we get producers? If you unplug, you're going to have to tell your own consumers you need to use down or bring down your own consumption, but also whatever else we need to use, where do we get it from? Where are the suppliers? It's not easy to get this from one day to another. And going back to Anne-Marie's point, you do see that the German government is getting very creative, trying to get other suppliers. But again, it's very difficult to lock in those contracts overnight. I mean, you know this very well, Jonathan. These are deals that just cannot get done in the space of 48 hours.
Today out of Brussels alongside Bloomberg's Anne-Marie. Those two on top of the story for you through the next couple of days. The President leaving Joint Base Andrews on his way to Brussels. As I say, 7 to 8 hours from now, he'll land into the European city of Brussels in Belgium. And then we'll have a big conversation tomorrow for NATO members. And then on to Friday, meeting his Polish counterpart as well. The President did speak a little bit earlier. When we get those comments on tape for you, we'll bring them to you. But I want to bring in our guests now. TD's Priya Misra, Morgan Stanley's Vishy Tirupattur, and Scott Kubie of Carson Group. Now, Scott, just on Ukraine and Russia, you said you're evaluating this along 3 time frames. Can you walk us through each of them?
Yeah, so the first one is what happens because of the sanctions. And, you know, I think that's what the story you were just talking about is that we've got these huge efforts to curtail the Russian economy from continuing to grow. But a lot of times Europe is directly affected by that. And when you look at that issue, the European markets, developed markets, are roughly 30 times the size of the markets that are adjacent to Ukraine, of countries that are adjacent to Ukraine. So it's really the sanctions have a lot more impact on our portfolios. To divorce that from the much more important human issues, but from a portfolio standpoint, that's a big issue. The second one is what happens because of escalation. I think the chemical story that you were talking about as well, as things have gone poorly in Ukraine for Russia, that is in some ways have raised the stakes of the types of weapons that would be used. That's a major risk factor because that entails what type of responses we'll make and eventually comes into NATO. And then the third is really the long term. We're transitioning from an era where the United States has been the absolute dominant power to one where there's some degree of multipolarity, probably more in China, but Russia wants to be have a seat at that table. And that raises its own levels of risk because it says that this won't be the last time that we have these types of conflicts, both with Russia, but other areas as well. Hopefully not as severe, but those are the 3 time frames that I'm looking at. And sometimes you get a signal where one time frame says, wow, this is really good for markets. But longer term, that might be a difficult one. And I think sorting that out and sorting out the human challenges from the market ones are certainly a difficult one for investors to do.
Priya, what about you? How are you thinking about the same situation at the moment?
Sure. So, I mean, the Ukraine war, I think, is a stagflationary shock, right? There's the weakness in global growth, there's high inflation pressure, and there's tightening in financial conditions. But at the same time, we've got significant domestic U.S. inflation pressures. I'm particularly focused on service inflation. That's high. I think that's why the Fed has this urgency, almost newfound urgency, to get to neutral. And which is why they're signaling, a 50 basis point hike is possible. I would argue multiple 50 basis point hikes are possible until we get to neutral. I think the market's sort of running away with going restrictive. And I think if you put it in context of the fact that inflation is high, wage inflation has picked up, but on a real basis is not keeping up with inflation. The consumer has a lot to contend with. So I do struggle with the restrictive talk because we also have QT happening. But for the Fed to get to neutral, I think the bar is pretty low and they're going to be aggressive. I don't want to say front loading, but they do want to sort of get to that neutral point and then reassess. And the market's pricing that in. I think we're pricing in 2.7 on the terminal rate. Again, I struggle with whether we get as high as 2.7, but I think pricing in 200 basis points of hikes over the next year, I think that's actually, the market's done a lot of the work for the Fed and they're going to deliver. I think now my focus is much more on QT and the market's just started to price that in. So I think there's still some more room for that.
Governor Waller speaking to CNBC last week, Vishy, and he talked about the data screaming for a 50 basis point hike. But it's the geopolitics that held them back last time around. The geopolitical issue is not done with. This market, to some degree, is treating it like it is. We're moving past some of this. Perhaps people don't believe it can escalate anymore. Escalating and hurting this market anymore, perhaps. Vishy, I wonder how you think about that issue and whether we get to a May meeting and we can focus exclusively on the data and not on the pictures that we're seeing at the moment.
Absolutely. I think this is really the crux of the issue. This is the very difficult place to be in for the central bank. But I think for the U.S. central bank, for the Fed, the near-term urgency, I think as the way Priya just put it, the near-term urgency is in combating in the potential for inflation to get higher and stay stickier. And therefore, I think they have clearly indicated, and there's a clear change of tone from the Fed that as the tightening of financial conditions, higher rates would be more front-loaded in our mind. So if we get a 50 basis point hike, it is more likely sooner, there is a window opportunity for them as they see it as things stands today. That opportunity is front-loaded for them to hike faster. And from 25 to 50, perhaps May, perhaps June as well. But that is how we see it. But this is really a tough market to navigate.
Vishy, you're going to stick with us. Vishy Tirupattur, alongside Priya Misra and Scott Kubie. An important trip for this president starts right now. We're about 20 minutes away from the opening bell. Let's get you some movers. Here's Abby.
John, well, we do have stocks. The futures cooling off a little bit from yesterday's rally, dragging Adobe. They put up an inline quarter, but it's really guidance that's worrying analysts. You have the analysts on the street worried that geopolitical issues, sanctions against Russia and Belarus are going to weigh. Microsoft down about 0.8%. This, as the company admits, confirms that the hacker group Lapsus breached its system and that group targets crypto exchanges. So investors are a little bit worried. On the other hand, General Mills pushing right through rising prices, up 2.6%. They have raised their outlook and they actually see price hikes driving sales. Apparently, pandemic trends of cooking at home really lasting and helping. And then GameStop, the meme trade not over, John. This stock up 30% yesterday. Today, in the pre-market, up 7.6% as Chairman Ryan Cohen has boosted his stake to about 12%. Cohen, who, of course, founded Chewy, he is an activist investor at this point. It seems everything he touches turns to gold. Investors like the fact that he's boosting his stake in GameStop.
Abby, thank you. Coming up, President Biden heading overseas to unveil fresh sanctions against Russia.
The president is traveling to Europe to ensure we stay united, to cement our collective resolve, to send a powerful message that we are prepared and committed to this for as long as it takes.
What this means for the Federal Reserve, next.
equities are holding up.
Stocks have been relatively resilient.
The rally in the market.
Markets are just getting a lot more comfortable.
Tightening is happening right now.
We're seeing the Fed doubling down on being extremely hawkish.
That puts a lot of pressure on markets to expect more rate hikes going forward.
Well, where do I go? Do you go into cash? Hell no.
You look at the 2-year, the 5-year, they've all priced in the tightening.
Do you go into bonds? Hell no.
People are looking at May saying 50 basis points starts to make a lot of sense.
They are certainly in the mode to raise rates right now.
You end up not reducing your allocation to equities, but actually looking to increase them.
It's Tina. There is no alternative to U.S. equities.
Now that works as long as we stay in a relative space.
Will we stay in a relative space? Let's talk to Bloomberg's Mike McKee. Mike McKee, fantastic word with the Fed speak over the last couple of days. Your take on what we've heard so far?
Well, there's been quite a change over the past week, and I'm not exactly sure what's causing it, but we did see Jay Powell endorse the idea of a 50 basis point move sometime in the near future, which markets are taking as May. And he's now been joined by many other members of the Open Market Committee, Fed Bank presidents and Governor Christopher Waller, who suggest that 50 is going to be the new 25, at least once, maybe more than that, as the Fed starts to worry about the odds of recession or inflation getting out of control. Now, in terms of recession, a sobering note from the Dallas Fed. These are the people who pay attention to oil prices in the United States. Yesterday, saying that if the bulk of Russian energy exports is off the market for the remainder of 2022, a global economic downturn seems unavoidable. This slowdown could be more protracted than in 1991. That was, of course, when the Kuwaitis were invaded by Iraq and their oil went off the market. That is a real concern that seems to be growing because Russian oil is largely off the market. Right now, we're seeing big discounts to Urals oil, and people aren't wanting to buy it. Now, here's the problem ahead. You look at that chart there, and you can see that for most of its history, especially when inflation's been this high, the Fed funds rate has had to go over the level of inflation in order to bring it back down again. Well, the PCE, the one the Fed follows, is 6.1% now. So when we're talking about the Fed moving up to neutral, are we talking about them going over 6%? That's a big question that we're going to be putting to Fed officials the rest of this week.
Mike McKee, should I share the bribe that the St. Louis Fed sent me? By yes. You to me.
Well, Mohammed was telling you to go into cash, so
they sent me shredded money from the Money Museum. How much is in that, Mike? Or how much was it?
I'm not sure. It depends on what the dollar value is. What you're comparing it to, the currency, cross currency.
Mike McKee, thank you. Thank you very much. Priya Misra, Vishy, Tirupattur, Scott Cooby still with us. Priya, clearly people are still trying to figure out what's going on with this Fed, how far they take it, how quickly they'll move. Have you drawn any conclusions yet?
I think there is a newfound urgency to get to neutral and to talk about going restrictive if they need to. I think I would say it's operative word or phrase, if they need to. But they're sounding hawkish. All they can do, they really can't impact inflation in the near term. What they are trying to do is tell us that they're not going to be behind the curve for too long, get those inflation expectations lower. If they're able to control inflation expectations, which I would argue are actually very well behaved, but a lot of that is, because the Fed is sounding hawkish, then they can prevent this from becoming a wage price spiral. But the operative word is nimble. I think there is no forward guidance. For those of us that lived through the last two hiking cycles, there was forward guidance. There was a path that we could project out. I think volatility stays very high. Once they get to neutral, I think then we should really debate, we should debate what is neutral, and then can they go above neutral? And I would say QT, even though the Fed says it's in the background, it's like watching paint dry, it tightens financial conditions. It's going to move long end rates higher. I think we should look at both. But right now, the communication from the Fed is let's get to neutral on the balance sheet, on Fed funds. And that's why I think the chance of a 50 or multiple 50s until that neutral, which I would say is closer to 2.25, I think until then, there's a very high chance that they sort of go much faster.
2.25. Vishy, what's neutral to you? Same thing, 2.25?
think around that time, at that level, I think the most important thing is that there is a likelihood that the Fed would need to go beyond neutral. I'll take it one step beyond what Priya just said. We think that the likelihood that the Fed will need to go, closer to the, 2 3/4 or 3%, is very much there. They would, in order to get the inflation down, they need to go beyond neutral. And I think the market is getting closer to pricing it. We're not quite there yet, but I think that is the direction in which we are headed.
Scott, since the Fed chairman started speaking, 2:30 Eastern time on Wednesday, the S&P's up more than 6%, up close to 6%, to be more precise. Is that a problem?
Yeah, I think it's a big move in the markets relative to a situation where the Fed seems to be wanting to get tighter than expected. I think the Fed's doing a great job of signaling where they want rates to go. I think their communication is good. And so I think the market sometimes just feels reassured that there's not as much uncertainty out there. One point I would probably disagree with what the other guest said, although I think a great opinions on those, is I don't see how we get to a sustained neutral rate of 2 1/4. We were there in 2019 in a great overall economy, and yet the Fed felt like it needed to cut rates 3 times in order to get that back below 2. I think that's one of the really interesting questions about what's raised the neutral rate enough that the economy can handle something in the 2s when it couldn't before.
It's not about the economy handling it, though. It's the market pushing back. We'll get into that in just a moment. Priya Misra, Vishy Tirupattur, Scott Kubie. Coming up on the programme, the morning calls and later, rate hike expectations growing, providing fresh fuel for the big US banks. That's just around the corner. About 5 minutes out from the opening bow, futures down 0.5% on the S&P and the Nasdaq down 0.7%. Muted considering the big gains we've seen over the last few days. That's the price action here in the morning calls. First up, Piper Sandler cutting its Adobe price target to $545, flagging growth concerns and potential complications from the war in Ukraine. KeyBank upgrading T-Mobile to overweight, highlighting the company's best-in-class 5G network. We're positive there, more than 1%. And finally, Stifel cutting its Carnival Cruise price target down to $30. The analyst adjusting his estimates to account for the recent surge in fuel prices. That stock just a little bit lower. Coming up, the big banks edging lower with treasuries stabilising from an unprecedented rout. That conversation is next. From New York, this is Bloomberg. "24 seconds away from the opening bell in New York this morning. Good morning to you. Your equity market down about 0.6% on the S&P. On the Nasdaq now down 8 or 9%. The Nasdaq 100 since the news conference last Wednesday with Chairman Powell up close to 9%. We've had a massive move into Wednesday. Switch up the board and get to the bond market. 10-year yields look a little something like this. Down a few basis points to 235, 234.98. The move on twos has been huge. Through the month of March, up more than 70 basis points, up in and around that kind of level. Jim Reed over at Deutsche Bank pointing out we're on course for the biggest monthly gain in the 2-year yield, going all the way back to 2004. Twos are down 3 or 4 basis points to 213 on my screen right now. Euro dollar backing down. Euro dollar 109.79, down about 4 or 0.5%, and crude back up more than 4% to 113.88 on WTI. And Brent, quick check of the Bloomberg for you. Brent crude 120.40, up by more than 4% today as well. That's the cross-asset price action this Wednesday at the open. 40 seconds in. Here's Abby.
A piece of that weakness that you were just describing for stocks on the open here, John. Tesla and other mega cap tech names. Tesla we have down after surging 8% yesterday. It seems as though investors are pulling back to some degree for some of these, again, big cap tech names. General Mills, on the other hand, popping up 4.2%, a very good quarter. Plus, they raised the outlook. They're managing rising costs very well as pandemic trends of staying home to eat home last. They're passing along rising costs to consumers just fine. You were mentioning oil surging with that Brent crude back above $120 a barrel. Occidental Petroleum, the energy sector, not surprisingly doing very well, up 3.8%. But with yields coming in just a little bit after that phenomenal surge that you were describing, weighing on banks. Bank of America down 1.2%, John.
90 seconds in. Abby, thank you. We're down 0.6%. As Abby pointed out, energy doing nicely, up more than 1%. On energy equities, we're up by 1.2%. Information technology, after a massive move higher, down by more than 1%. A lot more on the bond market, what it means for equities and the Fed as well. What does a hawkish Fed mean for this equity market? So far, not much at all, Kaylee. Not much at all.
Well, at least not in recent days so far since the Fed meeting, John, because what's interesting is you had equity markets down on the year going into the Fed meeting already, down about 5% or so on the S&P 500 as we stand now year to date. What's interesting is that since that Fed decision, that first rate hike and all the hawkish commentary that has come after it, we've seen the S&P 500 rally about 6%. So quite a reversal. What's been interesting the last few days is trying to find an explanation as to why. And if you look at history as a guide, maybe we see when you take a look at a simple log chart of the S&P 500, yes, Tom Keene, that one would be for you, and you pair it with the Fed funds rate, you can see that by and large through the different hiking cycles since the 90s, equities just continue to go up. The trajectory is still in the upward direction. And to put some firm numbers around that, during 3 of the past 4 Fed rate hiking cycles, equities have actually gained each and every month. For DM stocks posting an average monthly gain of about 0.5%. EM stocks were up about 0.6%. What I would note here, John, is the exception to this, that 4th hiking cycle where that was not the case. It was 1994 when global stocks actually were posting average monthly declines. And that was also the period where real rates rose the most. And the context around that is considering what we heard from Jim Bullard yesterday, saying that what the Fed should be trying to emulate here is the 1994 cycle when the Fed engineered a soft landing, raises the question of what this cycle will mean for this equity market.
That's the hope. That's the hope, Kaylee, and thank you. This time yesterday, we caught up with Mohammed Al-Erin. He talked about the relative story and the absolute one. The relative story, equities versus everything else, relative to cash, relative to bonds. Against cash, do you go into cash? Mohammed said, how no. Do you go into bonds? He said, how no. Relative to equities, equities for him still look good. He gets it. In fact, he said, quote, you end up not reducing your allocation to equities, but actually you look to increase it so long as this regime holds. Mohammed went on to say, what about the absolute regime? What about when we start to factor in what is going to happen to this economy and what is happening already? Take a listen to this.
We're going to see a global stagflation. We're going to see depression in Russia and Ukraine. We're going to see a recession in Europe. We're going to see stagflation in the US. And we're going to see a number of commodity importing developing countries running into debt problems.
I'm not sure if my guests are still with me or if they've run away. They're still with me. Priya Misra, Vishy, Tirupattur and Scott Cooby with us too. Priya Misra. Misery is the story right now for me. Misra, forgive me. Priya, that line from Mohammed, depression in Russia and Ukraine, recession in Europe, stagflation in the US, debt problems in developing economies. Is it that bad? Is the year ahead going to be that bad?
I mean, that is one scenario. I do think I'm much more concerned about growth in Europe. When I look at the US, I think it's going to come down to does the Fed engineer that soft landing? I get a little nervous when they talk about 94 as being a soft landing. It was for the economy. It was awful for the market, for the bond market, for the equity market. And that was a function of high volatility throughout the hiking cycle. Remember, they went 20, 50, 75. And it was a scenario where they absolutely went above neutral. Now, I think right now I'm not as concerned because I do think the Fed wants to get to neutral and then reassess. If they signal that they want 10-year real rates positive, they want to get back to 2018 levels, or that they want to go restrictive, I think then the stagflation scenario becomes much higher. If they are serious about engineering this soft landing, I would argue they're going to get really nervous as they get close to neutral. As they look at the balance sheet, there was no balance sheet runoff in 94. They realize that also tightens policy. If they are able to stomach a little higher inflation, but at the cost of trying to get the soft landing, I think then equity markets and the economy can handle it. I think it's a question we'll be all grappling with second half of the year. Right now, it's a little easier in a way for the Fed because they're so far away from neutral. This will become the key question as we get close to that neutral level. Which you think is close to 2%. Vishy, Scott hinted at this. Something can be problematic for the market before it's problematic for the economy. And Priya just basically said it in 94. Yes, a soft landing for the economy, but for the market, a different story. Can you pair that up for me? Just go through the two dynamics, what it means for the market, one, and the economy, two.
Right. If you actually step back and look at 1994, we started 1994 around, I think, if I remember right, the target Fed funds rate was at 3%. We ended a year, I think, around 6% in 94. And we, in middle of 95, perhaps July of 95, Fed cut rates. After reaching 6%, they cut rates from 575, and they went. I think we had 3 more rate cuts in 1995 and early part of 1996, before they resumed a hiking cycle. So I think where I think about this is that we should not think about this as secularly, rates will just keep going higher. And I think what happens is that we think we'll go beyond neutral. And at a point of reassessment of where it is, I wouldn't be surprised at some point in the not so distant future, we might actually see a cut, and then perhaps another hike. Things like that could happen. So I think the Fed needs to be, and I expect them to be nimble as the underlying conditions change. But first, we need to get past neutral. And if you think about that, one thing that we have now that we did not have in 1994 is this massive balance sheet. And the massive balance sheet is much bigger even after QE1, QE2, QE3. What we have now is much bigger. So there is another dimension to it in terms of how the balance sheet unwind kicks in. We think they'll start unwinding the balance sheet. The QT kicks in the May meeting. But how much, how fast will kick in will be something that we need to pay close attention to.
John Riley thinks the mistake has already been made. Scott Kubie, Mohammed said the central bank appears to have a choice between risking a recession or prolonging inflation. It's that binary. Pick your poison. It's one or the other. Scott, do you see it the same way?
I think at one level, yes, but at another level, I think there's some things that could really help the Fed out. More people coming back to work, increased supply, the decline in COVID cases. COVID really had some inflationary impacts. And if that continues to wind its way back, we could really see some benefit from that as far as the overall challenges to supply chain. I think some of the challenges that the Fed has are, it's hard to manage around a war. That's not in their expertise or in their core zone. It's also hard to manage around some of the challenges that we've seen out of China and other areas where they continue to shut down areas or respond very strongly to COVID cases while the rest of the world is opening up. So a lot of it's on supply of labor and supply chains healing. That could give us the Fed a lot of help on the inflation front and allow it not to raise rates as much as it might.
9 minutes into the session, equities down about 0.7%. Talked a lot about energy already, up 2.5%. The financials just a little bit softer. Taking a look at that. Back with us, here's Kaylee.
Well, John, it's been a really interesting story for the financials this year because by and large, basically until a few weeks ago, the trajectory was down. You had concern about growth, about inflation, about ultimately what that was going to mean for some of those more cyclically sensitive assets. But since that bottom on March 7th, this KBW Bank Index has actually rallied about 10%. Where that leaves us all said and done is still lower by about 0.9% on the year. So the question is, will a more aggressive Federal Reserve and higher rates turn this story around? And when you look beneath the surface level of the financials basket, you'll see that banks are actually lagging other areas like insurance and diversified financials. Of course, for diversified financials, a lot of that's Berkshire Hathaway. You can kind of put that to one side. But for insurance, maybe that outperformance of 7% gain year to date does make sense, considering that is a space that tends to be super sensitive to rates rising. And turning to those rates rising, John, obviously we have seen yields moving higher in dramatic fashion, especially over the last few days. The 10-year yield is now about 86 basis points above where it started the year and 65 basis points above where it started the month of March. Yet the financials have actually been lagging that move in yields. One could argue that is because the move at the front end has been even more aggressive, and as a result, the yield curve has aggressively flattened. But also with that gap, when usually these two lines track each other so closely, trade so much in tandem, it could indicate that the financial sector has some more room to run here, John.
Kelly, thank you. We have this debate every single time we see a move like this in the yield curve. What does it mean for the banks? Let's separate this up. What does it mean for profitability at the banks? And what does it mean for the multiples of the banks? What does it mean for the actual earnings of the banks? And what does it mean for attitudes of the investor towards the industry group? Bank of America wrote this. In the 90s, S&P 500 banks' earnings were 80% correlated with the yield curve. The banks have changed. Correlations have dropped to 17% since the year 2000. Bank of America go on to say, but the sector's PEs still move in lockstep with the curve, an overly simplistic reaction that ignores history and fundamental sector changes. So, Scott, I'm going to come to you on this. What matters more, the yield curve and what it actually means for earnings, or what it actually means for investors and how they allocate to the industry group? Because it's all well and good you and I saying banks have changed. It doesn't matter to the earnings like it used to, but ultimately if the investor, the end investor, the group of investors still believe that it matters to the banks, they're not going to be in them in the same way.
You know, I always try to sort the short term from the long term impacts. And I think what we're going to see is it continues to get back to the key earnings and key sensitivities of those. And that's going to drive it. Now, these short term reactions, we saw it with the 10-year Treasury, in the recent months or recent weeks where it went down and shot right back up again. There's going to be a lot of volatility as investors are nervous. They're not experiencing. We're talking about 1994. That was a long time ago. That was before I was a professional investor to go back. And I've been doing this a long time. So going back to all these different histories and different applications, tough for investors to manage. Expect a lot of short-term volatility. Stay focused on long-term, and you're going to end up in a better shape.
Priya, this is going to sound like a real yield type question. 2s, 10s in and around 22. What do we get to first, 0 or 50?
I think we could get to 0 in the near term because the Fed has not told us much about QT. I go back to Vishy's point. It's such a huge deal, QT or balance sheet runoff. We don't know the caps. We don't know how long they're going to phase it in. So the market doesn't know how to price in QT. If we were getting QT details right away, I think we would get to that 50. But right now, it's all about hikes and 50 basis point, how many 50 basis point hikes we have this year, which is putting upward pressure on the 2-year. Once we get QT details, which we think we'll get in May, I think then the long end will start to participate in this move.
Vishy, do you agree? Is it too difficult to make a year-end call on the yield curve? I think it's difficult at the best of times anyway, without a deeper understanding of what's going to happen with the balance sheet?
It's certainly difficult. We have made the call. And we will be nimble and think about how, depending on as the more details emerge. As of now, we think that the year-end will get to the 2-year will get to 275, and the 10-year would be at 240 is our base case. So we expect to see a meaningful inversion between 2s and 10s that goes all the way to 2 years from 275 to 240. That is what we are thinking. So,
Vishy, that's a big call. Let me jump in. Vishy, what damage does that do to broader credit? Do you think it damages appetite for broader credit when you start to see that dynamic evolve in the way you expect it to?
So I think we need to distinguish between credit in the context of fixed rate credit and floating rate credit. So the credit is starting in a much better place now than they were in previous points of when the Fed was at the onset of a hiking cycle. Credit is much better, and that's true in investment grade or high yield and leveraged loans. But for the most sensitive part here, more vulnerable part here, is that if we get a much more aggressive hiking cycle that comes much more front-loaded, that puts more pressure on the leveraged loan companies that depend on leveraged loans, the floating rate instruments for financing. And you have to look at it in the context of how does that higher cost of funding jive with earnings growth. So if we assume that the earnings growth stays positive, I think we'll be okay. If earnings growth turns negative, and that turns negative sooner, and you actually start seeing rate hikes coming through much earlier, then we could see a challenge to the leveraged loan dependent companies. But we think I think we should not forget that we are in a much better starting point than we were even in previous cycles, in particular the 2009 cycle.
Vishy, got to leave it there. Thoughtful stuff with Priya Misra, Vishy Tirupattur, and Scott Cooby. To the three of you, thank you. About 15 minutes into this session, we're down 0.8%. We pulled back on the Nasdaq by more than 1%. Coming up, Ukraine urging the EU to target Russian energy.
What we care about most is bringing Russia's war effort, Russia's war machine, to a halt. And that can be done by putting them into a serial fiscal problem. And that will be done through an oil and gas embargo in Europe.
What sanctions could mean for prices in Europe and beyond. That's next.
What we can do is put pressure on the Russian regime economically. That means increasing further sanctions as far as the revenues from oil and gas sales to Europe are concerned. So an oil embargo, a gas embargo would really help in the sense of bringing Russia's war effort to an end.
That's the ask. Right now, clearly Europe incredibly divided as the president leaves Washington and heads towards Brussels. Western allies meeting in Brussels as the EU considers fresh sanctions on Russian energy. Bank of America's Francisco Blanche had this to say.
Our ugly scenario is $200 a barrel plus, and the way we get there again is pretty simple, right? I mean, if you think about every million barrels a day of disruptions from Russia equates to $20 to $25 a barrel on the price. So if we get to go from a million plus to 4 million or so, we have to add $60 to $70 a barrel to our baseline spike scenario.
If we can find an agreement, Will Kennedy joins us now from London for more. Will, are you expecting sanctions to ramp up on energy again anytime soon?
There's clearly a lot of pressure for that to happen from many EU members, and I think the US and the UK would like to push Europe in that direction. But I don't think we're close to any agreement among EU members. Germany and the Netherlands, Hungary, all remain opposed. For Germany, which gets a huge proportion of its oil through a pipeline from Russia, it would be extremely disruptive. So pressure is building. I'm not sure we're there yet, but we'll see. There's clearly going to be a lot of pressure at this meeting, and we'll see what comes out of it.
Well, how is this going to work? What we heard from the Russian president via Interfax this morning, through Interfax, the Russian press agency, that the president, Vladimir Putin, would like so-called unfriendly states to pay for Russian gas with rubles. How will that actually work?
It's a really interesting question, and I think everyone's trying to unpick that now. The gas market has rallied more than 20% on that news, and Brent is a lot higher. Presumably, buyers would have to open accounts in Russia and purchase rubles to complete their transactions. I think there are two questions. One, will that be allowed under the current sanction regime? And two, has Russia breached their contracts by insisting on this? It's clearly an escalation. It's clearly more evidence that both sides are starting to use energy in this conflict as a weapon. When the war started, there was clear effort on both sides to carve out oil and gas flows. Europe wanted to avoid maximum economic disruption. Russia wanted to be seen as a reliable supplier and protect its revenues. That's clearly changed over the last 4 weeks. Both sides are starting to use energy as a weapon.
Well, Kennedy, it's a good final point. Thank you, sir. Even if it is a breach of contract, the issue that the Europeans have, typically if you have a breach of contract, you get to go somewhere else, right? You get the choice of finding someone else to do business with, and the Europeans, particularly Germany, don't even want to look at that at the moment. In fact, they can't make that decision, even if they do want to look at doing that. It's about cutting dependence. That's the phrase you'll hear. Cutting dependence, not banning, cutting dependence. Crude, 120.53 on Brent, 114 on WTI with a sector price action. Just quickly, here's Abby.
John, well, perhaps it's that big price for oil that's really cutting into stocks. The S&P 500 looking at its worst day in a week and a half. Not surprisingly, most sectors are lower, led by tech. Up top, though, energy and consumer staples. That's a defensive sector being helped out by General Mills. A good quarter and outlook there. The best day since March of 2020. Over the last year, consumer staples, they've fared okay. That defensive sector doing well from the pandemic trends, up about 14%, John.
Abby, thank you. Coming up, your trading diary from New York. This is Bloomberg. We're about 25 minutes in here. Equities are pulling back 0.75% to 1% on the S&P, and the Nasdaq down a little more than 1% after a really big rally since Wednesday, really, after Chairman Powell spoke. We just kind of melted higher, particularly on the Nasdaq. We pulled back just a touch. The move in crude, one to watch. WTI and Brent pushing through 120. WTI crude through 114 as Russia tables this, the idea that unfriendly states will have to pay for Russian gas with rubles. That's an extra part of the energy story to think about. That's the price action. Here's your trading diary. This is what things look like through the next few days. New home sales at the top of the hour. EIA crude oil inventory report, 10:30 Eastern. US Treasury auctioning 16 billion in 20-year notes at 1 p.m. Fed speak continues. Daly, Bullard, Kashkari, Waller, Williams on deck throughout the whole week. President Biden meeting with allies in Brussels tomorrow, then on to Poland to meet with his Polish counterpart on Friday. This week gets busier as we close things out. From New York, thank you for choosing Bloomberg TV. This was the countdown to the Open. This is Bloomberg.